Hello viewers. Have you ever been scammed? Join me as I uncover one of the biggest modern-day Ponzi schemes. On behalf of Sen Securities, I'm Erica Trina. We'll begin by emphasizing the importance of practicing due diligence when dealing with individuals or organizations that operate in financial markets. It's often challenging to distinguish genuine market participants from scammers and fraudsters. In the volatile world of cryptocurrency, few stories resonate as profoundly as the rise and fall of Sam Bankman-Fried and his brainchild, FTX. What began as a visionary venture to reshape global finance unraveled into one of history's largest financial frauds, shaking markets and trust alike. In 2019, Samuel Bankman-Fried, a 27-year-old MIT physics graduate known as SBF, stood poised to disrupt the cryptocurrency landscape. Fresh from a stint at Jane Street Capital, where he honed his quantitative trading skills, Bankman-Fried channeled his analytical prowess and effective altruism ethos into a new venture. Alongside Gary Wang, a former Google engineer, and others, he co-founded FTX, a cryptocurrency exchange incorporated in Antigua and Barbuda, with its operational hub in the Bahamas. FTX, short for Futures Exchange, aimed to offer a seamless platform with sophisticated trading tools, targeting both retail and institutional investors. Its launch coincided with a crypto bull run, and by July 2021, FTX had surged to become the third largest crypto exchange by volume, boasting a $32 billion valuation and over 1 million users. Bankman-Fried's earlier venture, Alameda Research, founded in 2017 with Caroline Ellison and other MIT peers, was integral to FTX's ecosystem. Alameda, a crypto hedge fund, capitalized on arbitrage opportunities, notably the kimchi premium, where Bitcoin prices in South Korea exceeded global rates. By 2019, Alameda's trading strategies had amassed significant capital, but its reliance on high-risk bets would later prove catastrophic. Bankman-Fried's unconventional persona, marked by disheveled hair, cargo shorts, and a penchant for napping on office beanbags, endeared him to Silicon Valley. Venture giants like Sequoia Capital and SoftBank invested over $400 million, captivated by his multitasking flair, exemplified by playing League of Legends during a pitch call. FTX's marketing blitz, featuring endorsements from Tom Brady, Gisele Bündchen, and Larry David, and a $135 million naming rights deal for the Miami Heat's arena, cemented its mainstream appeal. Beneath FTX's glittering facade, a perilous entanglement with Alameda Research festered. From the outset, Bankman-Fried blurred the lines between the exchange and the hedge fund. FTX's terms of service promised customer funds were secure, yet Alameda enjoyed a secret exemption from the exchange's auto-liquidation protocols, enabling it to accrue vast margin positions. By 2019, Bankman-Fried, Ellison, Wang, and Nishad Singh, FTX's engineering director, were allegedly diverting customer deposits to Alameda. Over $8 billion was siphoned to cover Alameda's losses, fund speculative investments, and bankroll Bankman-Fried's personal ventures, including a $500 million stake in Anthropic, an AI startup, and $200 million in Bahamian real estate. This commingling, concealed from investors and auditors, exploited FTX's lack of oversight in the Bahamas, where regulatory scrutiny was minimal. The house of cards began to wobble in September 2022, when Bloomberg highlighted the murky ties between FTX and Alameda. On November 2, CoinDesk published a leaked Alameda balance sheet, revealing that $14 billion of its $14.6 billion in assets were tied to FTT, FTX's native token, a token with negligible external demand. This disclosure rattled global financial market participants, who questioned FTT's stability. On November 6, Binance CEO Changpeng Zhao, a former FTX investor, announced plans to liquidate $2.1 billion in FTT holdings, citing recent revelations. The news triggered a bank-run-like frenzy, with FTX users attempting to withdraw $6 billion in 72 hours. The exchange, however, faced an $8 billion shortfall, unable to honor withdrawals due to the misappropriated funds. Bankman-Fried's attempts to stabilize FTX were frantic but futile. On November 8, Binance signed a non-binding letter of intent to acquire FTX, only to retract it within 24 hours after uncovering evidence of mishandled customer funds and U.S. regulatory probes. Inside FTX, morale collapsed. Dozens of employees resigned, withdrawals were halted, and Bankman-Fried's inner circle grappled with the unfolding crisis. On November 11, FTX, Alameda, and 130 affiliated entities filed for Chapter 11 bankruptcy in Delaware, with Bankman-Fried stepping down as CEO. John J. Ray III, a restructuring veteran who managed Enron's bankruptcy, took the helm, describing FTX's state as unprecedented, a complete failure of corporate controls, with no reliable financial records and up to $9 billion in customer assets missing. The collapse sent shockwaves through the crypto ecosystem. Firms like Three Arrows Capital, Voyager Digital, and BlockFi faced liquidity crises, while Bitcoin's price plummeted below $16,000. FTX's implosion wiped out billions in investor wealth, leaving 5 million customers worldwide uncertain of recovering their funds. Bankman-Fried's philanthropic pledges, including $190 million through the FTX Foundation, evaporated, impacting initiatives like Vox's Future Perfect. His political influence, fueled by $27 million in donations to Democratic PACs and $69 million in 2022 election contributions, drew accusations of campaign finance violations. Globally, financial markets reassessed crypto's viability, with regulators intensifying calls for oversight. On December 12, 2022, Bahamian police arrested Bankman-Fried at his $40 million Nassau penthouse, acting on a U.S. extradition request. The next day, the U.S. Attorney's Office for the Southern District of New York unsealed an 8-count indictment, charging him with wire fraud, securities fraud, money laundering, and conspiracy to defraud the Federal Election Commission. The SEC and CFTC filed civil complaints, alleging Bankman-Fried misled investors, raising $1.8 billion by concealing FTX's fund diversions. Extradited to the U.S. on December 21, he secured a $250 million bond, the largest in U.S. history, and was confined to his parents' Palo Alto home. His parents, Stanford law professors Joseph Bankman and Barbara Fried, stood by him, asserting his innocence. Bankman-Fried's legal saga escalated. In January 2023, he pleaded not guilty to all charges, but his bail was revoked in August after he leaked Ellison's private writings to the New York Times, prompting accusations of witness tampering. Remanded to Brooklyn's Metropolitan Detention Center, he faced harsh conditions, reportedly subsisting on bread and water. His trial, beginning October 3, 2023, exposed the fraud's scale. Ellison, Wang, and Singh, all of whom pleaded guilty, testified against him, detailing how Bankman-Fried orchestrated the misappropriation of $8 billion in customer funds. Evidence included coded software enabling Alameda's unchecked borrowing and Bankman-Fried's directives to conceal the shortfall. On November 2, 2023, a jury convicted him on all 7 counts, branding his actions among the largest financial frauds ever. On March 28, 2024, Judge Lewis Kaplan sentenced Bankman-Fried to 25 years in prison, with 3 years of supervised release and an $11 billion forfeiture order for the massive fraud. Kaplan rejected Bankman-Fried's claim of no investor losses, emphasizing the deliberate nature of his crimes. Now incarcerated, Bankman-Fried's appeals are ongoing, though legal experts doubt their success. His co-conspirators faced lighter sentences. Ellison received 2 years, Wang 18 months, and Singh 5 years probation, reflecting their cooperation. FTX's bankruptcy proceedings, led by Ray, have recovered over $7 billion, including $884 million from selling Anthropic's stake and $2.4 billion in cash and crypto. In October 2024, the estate proposed a reorganization plan to repay 98% of creditors, potentially returning $12.7 billion to customers, surpassing initial expectations. However, payouts depend on volatile crypto prices, and some investors may receive less than their original deposit's value. The plan, pending court approval in 2025, aims to conclude one of the most complex bankruptcies in history. The path forward is uncertain but instructive. FTX's collapse has galvanized regulators worldwide. The SEC and CFTC are drafting stricter rules for crypto exchanges, while the EU's MiCA framework and Singapore's enhanced oversight signal a global push for accountability. Financial market participants now prioritize transparency, with exchanges like Coinbase adopting segregated custody to protect client assets. The crypto industry, though bruised, is rebounding, with Bitcoin surpassing $60,000 in 2024. Yet, the specter of FTX looms, urging vigilance against unchecked ambition. To sum up, the FTX saga, driven by Bankman-Fried's hubris, serves as a stark reminder of the risks in unregulated markets. From its meteoric rise to its devastating fall, it exposed vulnerabilities that global financial stakeholders must address. As FTX's customers await restitution and the industry evolves, the lessons of accountability, governance, and trust will shape the future of finance, ensuring that no single visionary can again imperil millions. Thank you.